Trade tariffs put a damper on stocks today. How much of a damper? I'm going to break down today's move in context of the posture to see if it changes this bullish posture. So has it changed? Are we still bullish? Are we transitioning towards bearish to take into account what's going on? Who's getting hit the worst from this tariff news? I'm going to talk about all of that and look for a trade idea on the stock that kind of bucked the trend today and broke out to new all-time highs. So let's go ahead and get started. Today is Wednesday, July the 11th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thanks for tuning in tonight. We appreciate you watching the video, especially those that are watching for the first time. Glad you found this. Come back for more. Subscribe to our YouTube channel. Mouse over the Market Scholars logo in the bottom right corner of your screen here. Click the red subscribe button that pops out. Click the thumbs up icon down below the video. That tells us you like the video, you want us to keep doing it. Comment on anything that stands out to you further down below. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click on that link and subscribe. Follow on Twitter for more content like this, and join our Market Outlook community on Facebook. All right, well, let's take a look at the S&P 500 today. Interesting day today, obviously. Pullback, dropping down, dropping about 20 points today, about almost 0.75%. Bringing the short-term sentiment lines down. That's no-brainer, right? The momentum line, though, came really close to extreme lows. We quantify extremes as below 5 on the downside and above 90 on the upside. And so you can tell things can get extreme a lot easier on the downside than they can on the upside. In fact, we haven't had an extreme high point since back here on the upside, and that was followed immediately by an extreme down, and we've had multiple extreme lows since. So, you know, the extreme lows, that's why we have it down at 5 instead of, say, 10, or up here at 95, just because it, you know, rarely gets up to 95 on the upside. So we obviously had a pullback. In fact, this is what's called an intermediate confirmation signal. Now, it's not picture perfect, all right? The idea behind an intermediate confirmation signal is you have a bullish trend with an oversold momentum line, right? That is the simple definition of that signal: bullish trend and an oversold momentum line. What makes it improved is the fact that the intermediate line's up above 80, in which case it's not. It's almost, but it's not. Ideally, you want the near-term line to stay above 5, not drop to extreme lows. It came pretty darn close, so both of those things are kind of knocking on the door. We don't have that, but we're close. We don't have that either, but we're pretty close too. So it's not the best intermediate confirmation signal. And then the last thing is you would like to have the momentum line between 20 and 50. That's kind of the ideal setup for an intermediate. Regardless, the concept is it's kind of a buy the dip signal. You got a dip. You know, it ended up being a pretty small range today. As bearish as we started out, we didn't really go that much further down. In fact, I kind of thought we'd get down to 2750 once we broke through those lows this morning. You'll see here on the intraday chart. And we didn't really follow through on a lot of that bearishness. So that's a little telling in terms of how bearish this move was. Like I said, the intermediate line's rising almost up into that reversal zone. The Dow has been lagging. It also barely avoided extreme lows on the momentum line. The near-term line had just gotten to the upper reversal zone there. Here, I'm just getting rid of these drawings simply to make it easier to see. Just barely got up into the upper reversal zone. Just barely got above 50 after a few days, and is already starting to pull back. You look at the NASDAQ composite, also bullish posture, intermediate confirmation signal. This one is a little bit better. It's not above 80 yet on the green line, but at least the red line is, didn't come close to the extreme lows like the Dow and the NASDAQ or the S&P did. You notice that we didn't go lower than where we opened on the NASDAQ, unlike the S&P 500 and the Dow Jones. And then finally the Russell 2000, which has been the most bullish. Its intermediate line is in the reversal zone. We did get an extreme low, so this was a pretty decent sell-off today from a near-term basis. Here, let me get rid of the drawing here too, just to make it easier to see. It looks like kind of forming a double top pattern on this. Again, strong bullish posture. Everything would be there for a buy the dip signal except for that extreme low on the near term on the momentum line. Now, you do tend to get more extremes on the Russell than you do on the S&P, just simply because this is a more volatile index. It ended up about the same loss as a percentage basis than the S&P 500. But that's the only, other than that, if that were up at 10 like the NASDAQ, then this would be giving you the picture perfect bullish intermediate confirmation signal. The combination of an overbought, an intermediate line in the upper reversal zone, an oversold momentum line, and then the near-term line falling into the lower half of the chart. So, I still think, because we just barely started this intermediate run, I still think that we do have the opportunity to bounce off this short-term signal. Of course, things can change, and news event can change that. This trade war and the sell-off that we had today, the fact that we didn't follow through so much on the initial selling tells us that it's not like, see, back in January when things started to sell in the mornings, it went all day, and then again it opened up here and went all day, and then it opened up there and went all day down. So we're not getting these all-day sell-offs. We started down, bounced up on a few of these indexes, and then finished closer towards the lows. But it wasn't an all-day sell-off of a large range from a high to a low point, and that can be a little telling in terms of, again, how bearish we are. Remember, we're green right now, dark green on the Russell 2000, dark green on the NASDAQ Composite, light green on the Dow because we haven't crossed above 50 yet, and then dark green on the S&P. So despite the pullbacks, we're still showing stronger bullish postures across the board here on the major indexes. All right, as always, there's a link popping up in the top right corner of the screen here that will take you to our Market Scholars blog, where you can watch this video if you're not already doing so from there. On that page, we ask for 3 clicks. These 3 clicks tell us you like the video, you want us to keep doing it. That is one right here on the Twitter page, liking tonight's Market Outlook tweet. You can do it right from here. Pulls up a new window that you can like while you're watching. Clicking here will take you to the Facebook page where you can like that post as well there, and then finally liking it here on the blog. Remember, you can share it across these different platforms as well. We got up to that's a new high number that I've seen, 46 shares. So let's see if we can't eclipse that number here today. Remember, you can do all this while you're watching the video. As you scroll back up to the top, you can join our site by clicking on this link, and by joining you can connect with other market scholars, including myself. You can see other market scholars here by clicking on members, and you can also participate in the Market Outlook forum by subscribing. Again, just clicking on that link. It's an easy forum. Make sure you do that tonight if you haven't done so already. All right, back to our charts. Looking at the long-term view again. Short-term pullback today still keeps us above a rising 50-day moving average, above a rising 200-day moving average. The gap between the two is also still rising slightly. So short pullback hasn't changed that long-term narrative that we are bullish and expect to continue to be. If you take a look at the 3 green arrows, so the other intermediate term chart, we still got 3 green arrows. So 1-day pullback, again. And as of right now, I'm kind of expecting this to still just to be a buy the dip opportunity here, and we continue on this. As you can see, we're green across the board on most of these charts. The 3 green arrows. If you take a look at the 2 line versions of those 3 green arrows there, here, let me get rid of that drawing so you can see a little bit better. The 8-day is above the 17-day moving average. They're both just about above the 30. You can see the MACD is above 0. Its moving average now is crossed above 0. Same with the stochastics. Moving average is also crossed above 50 as well. So now on the short-term chart, there's the pullback. And again, context here. You see we're easily still in the upper half of the chart on this pullback. We basically pulled back to the that 23% Fibonacci level, or 78, depending upon where you draw the lines. Again, it is a lower high and a lower low, but a pretty tight range, relatively speaking. even if you include the gap, you can see that we closed here at 278.82. The low was there at 276.52. So we're looking at a 2.3 point range. When you look at that on that relative to its ATR, so it's below average. Today's range was a below average range. That just kind of shows the volume. You can see even the volume was average. It didn't really spike up or was any stronger at 76.9 million. You put those numbers in the context here. You can see the ATR again below average. The volume is slightly below average too, or no, it's slightly above average actually. But that average, for both of these, relatively low in their 52-week ranges. And of course, the relative ATR is below that 1% mark. Bearish below 1%, or excuse me, bullish when you're below 1%, bearish when you're above 1%. You get a lot of volatility up there. Bearish posture at least. So again, I mean, how can we be too bearish here when a lot of these technical indicators are still showing bullishness? I mean, just because you have a bullish posture doesn't mean you go up every day, right? You're going to have down days. And if we look at every down day as the end of a bullish run, or every down day as the beginning of a bear market, then you're gonna need to go to Costco and buy a few cases of Pepto-Bismol because you're going to have some rough roller coaster rides from day to day watching the markets, because not every market is like this, right, where we just go up just about every day. It's like breathing. There's inhaling and exhaling, and when you exhale, that doesn't mean you're dead or dying, right? It just means you're breathing. And that's the same case here. And as of right now, that's kind of what we would classify today as. And you look at the volatility here, and you see we didn't really even get a big spike in volatility. It jumped up to 13.5. It didn't even get up to 15, which is kind of where we look for some resistance there. And right now, this peak would be much lower than the last peak that we had. We wouldn't expect a big lower low. I mean, we're 12, looks like 11.5 to 12 is our low end of the range. If you look at the volatility, relatively speaking, to the back month volatility, you can see, despite today's bounce, it's still in the bullish range. It's still below 90%. A VIX to VXV, the 3-month VIX. So again, how can we be too significantly bearish when all these technical indicators would suggest not to be? So to summarize our posture today, and there's a link popping out in the top right corner where you can poll, where you can vote on whether you disagree or agree with this posture. Remember to comment down below on the YouTube video if you do disagree with this posture. Love to hear what you're seeing or what we haven't talked about that may be relevant to this discussion. But the summarized posture here is we are still bullish, and we are still leaning towards a stronger bullish posture. And today's pullback is nothing more than just a breather, just a near-term breather that is actually setting up a bullish intermediate confirmation signal across a lot of these major indexes. That would be quite the perfect scenario for a bullish intermediate confirmation signal on the Russell 2000, if not for that more extreme low point there. But there's an asterisk on that one because the Russell 2000 tends to get more extremes because it tends to be more volatile than the S&P. So one day selling still hasn't changed the fact that we're on this bullish intermediate trend that we expect to last 1 to 3 months, probably 1 to 2. We're closer to 1, or in that shorter time frame, and that we just barely are a few days into as of right now, and one sell-off day doesn't end or change those expectations. All right, now let's transition to what's driving the price action today. And if you look at this chart, first of all, you look over here, you can see there's the two things that were up today out of these major asset classes. One was the dollar and the other was long-term bonds. So it was a risk-off day. High yield was down a little bit. Preferred stocks also down a little bit. There's foreign bonds lagging behind the U.S. Counterparts, of course. You can see here, though, crude oil, some of the biggest losers, agricultural commodities were down nearly 2%. Crude oil was down tremendously, down almost 5% today. Emerging markets down almost 2%. developed markets dropping well below the U.S. stock markets. Gold, even with the dollar being strong, was down. So if you take a look at the move that we had, and again, this is all basic market reaction to this tariff news, right? It was U.S. stocks pulled back, but international stocks fell even worse, and they've been lagging behind. If you were to look at like a 3-month chart here, you can see U.S. stocks are up. The S&P is up 5%. The small cap stocks are up more than 9%. So they're still doing pretty darn well over a 3-month period. You wouldn't think that because the market, so the sentiment can be so bearish in a down day. But that's the 3-month return. You can see crude oil was up 12% over this 3-month period. So big drop there coming from the best performing asset class. But you can see even before today's drop, developed markets were down almost 1%. Emerging markets were down 8%. Now down more than that, obviously. You can see the dollar's been strong, and that's been putting pressure on gold and emerging markets. If I zoom out to a 6-month time frame, you can see again why crude oil dropped so much. It's been doing so much. It's been a lot more volatile than any other asset class, and you can see the strength in U.S. stocks still persisting even over the 6-month time frame, and then the strength in the dollar as well. So now zooming back out to the 2-week, or zooming back in, to the 2-week time frame. Stocks have been bullish, and now they're starting to pull back a little bit. And the dollar has been bearish over the last 2 weeks, so giving back some of its gains, but bouncing up today. So today was essentially a move back into U.S. assets, away from foreign assets and into U.S. assets. So right now, that's the market reaction to this trade war, the tariffs, and things like that. In fact, I brought this up in a class today. Here's the U.S. stock market. Among the 12 biggest economies out there, that was the U.S. stock market today. And U.S. stock market's up, was down 0.75%. India was the best performer, only down 0.5%. Russia was down 3.5% today. Brazil almost down 3%. Italy down 2.25%. There's China down 2%. Germany down 2%. France was one of the better performers, and Canada, those continue to be some of the better performers simply because they didn't drop as much. And you can see Japan there too, holding its value a little bit better than its other Asian. There's Korea down 2%. So you worried about a 7.7% loss when that's what we're seeing internationally right now? That again, this news. I mean, the money's got to go somewhere here. These are the 12 biggest economies, so the money's got to go somewhere. And right now, the money is coming out of these Asian and European markets, and it's holding its value in the U.S. And it's not going in the U.S. stocks per se, but you can see it's going to move into safe haven assets, even more so than, like I said, foreign bonds, which we're also down here. There's your foreign bond ETF. We're also down today. So another reason why I'm not as bearish on this short-term pullback, because the S&P has continued to show some resiliency against some of these bigger markets. These are the markets or economies listed in order of their size. So there's the U.S. above a rising moving average with a strong intermediate posture. There's your next two biggest down below a falling moving average with a strong bearish intermediate posture. Germany pulling back from a lower high. Same thing with the United Kingdom, France. India still kind of hovering around that moving average. They're all still bullish, but you notice below the 50th percentile, lower half of the chart, and below a falling moving average. Same thing with Italy there too. And then you can see Brazil was trying to get going here. Canada at least still is above its moving average and its intermediate lines above 50. And Russia had been a strength. It had kind of broken out, but giving back a lot of those gains here today with a big pullback. And of course Korea, like China and like Japan, stuck at some pretty sharp lows, well below So Asia, these Asian economies really getting hit the hardest by far. European economies also below downward trending moving averages with bearish postures. It really makes the U.S. market over here in the top left corner stand out. So how bearish you want to be in the U.S. stock market when you see all of this overseas. Really only two other major economies that have stock markets above their moving averages, 6-week moving averages, are Canada and Russia. Of course, from a sector rotation standpoint, you can see, not surprising that energy struggled the most. But there's your two sectors that struggle from the tariffs, and that is industrials and materials. You can see some of these safe haven areas. Utilities were up. Financials also beat the markets. Smaller drop than what the broad market got. But you can see, look at these two beating the markets as well, technology and discretionary. So here's their charts here, above a rising moving average for discretionary, above a rising moving average so far for technology, intermediate bullish posture with rising intermediate lines, whereas you can see these two, industrials and materials, also had rising moving average or rising intermediate lines, but below the 50th percentile on both of these. Look at utilities. Intermediate line still up above 80, had one down day but bouncing off of that down day. Real estate got a strong bullish posture, falling, but it doesn't matter if you're above 80. That's why it's still shaded green. And you can see staples also rising. Healthcare too rising. Pullback down today, lagging the market a little bit, but still rising. Strong bullish posture, rising above a rising moving average here. So, these areas, safety, which has been so beaten up, especially staples, starting to show some rotation. But you still have these market leaders from discretionary and technology. Again, another reason why not as bearish today. Otherwise, you would have seen these lagging behind the S&P. It was basically a tariff sell-off along with crude oil, as big of a drop it had, putting pressure on the energy sector as well. So one stock in particular that had a good day today, kind of a little bit of a breakout to an all-time high, actually, a closing high, not a new all-time intraday high. You can see the highest close Activision had over here back on March 9th was 78.22. Today we closed at 78.61, so new all-time closing high, closing above a lot of high points here over the last few weeks. Getting 3 green arrows, already above the rising moving average. MACD showing green, stochastics bouncing back up after bouncing down a little yesterday, and then a decent amount of volume today. So when you look at that, it's like an engulfing pattern there, coming off this moving average, ready to bounce up and make its way higher. You can see if I were to look at some of the other charts for the same stock, you can see the market forecast is bullish. Near short-term sentiment bouncing back up, the intermediate line moving up to the upside as well, already above 50, so that's why we're green on that one. You take a look at the long-term moving averages. You can see we're above a rising 50-day moving average, 200-day moving average. Strong moves higher, a strong trend, a long-term trend. You take a look at short-term charts that we saw. Obviously, if you're getting all-time highs, you're trading pretty decently higher. I want to take a look at the Bollinger Bands here for Activision. Getting up above the upper Bollinger Band, coming up from a low bandwidth. So high above 100 on the percent B and coming up off of a low bandwidth. And then finally, looking at the DMI charts, you can see here too, that we're crossing up above 25 with the ADX making its way up to above 20. So positive technical trends across the board, and obviously a big range compared to average today. So a little bit of a breakout move. We can take a look at buying, but you remember again, how bullish the market is. On a down day like today, looking for a high probability trade on this. We did a buy trade on my last video in the healthcare sector for a long stock. Here we'll go back to just doing a bullish options trade. The thing I like about doing this particular trade is you can sell the 75 and buy the 72 and still get a decent credit here. You do have, if I take a look at, here let me add some days here over to the right. Let's go 40. Let's make sure. You do have that coming up, August the 2nd. So you have earnings. That doesn't necessarily mean we have to avoid the trade. It just means that we have to account for that risk. So if normally you put 1% at risk on a vertical spread of your active trading portfolio, you probably would only use 0.5%, again, to account for that risk. You keep the trade small when there's an event risk like that coming up. That way, if things do blow up in the wrong direction for the stock, you won't be impacted nearly as much on this position, and you can spread it out across different positions, right? So we can sell that 75, and the nice thing about the 75 is that's where the low point of today's move was. So as you got some support in that area, you can see, go back to the 3 green arrow chart here. You got some support down here at 75, simply from the lows of the past week and the low of today's candle before we made our move higher. So that's where that's where, whoops, let's go to the risk profile, and we'll take a look at a single symbol on this one, and we'll do set slices to break even and get this onto the chart there. Let me make sure we set parameters. So you got a pretty high probability of success, 67% chance of making money. Of course, you're either gonna, at 75 to 72.5 is the break. That's where, that's the gap between max gain, max loss. So it's pretty, it's not a whole lot of wiggle room. Only $2.50. You remember the ATR is 1.78. So this is more than a day's worth of move. And you can see in that range, you've got not very much room of gains and a lot more rooms of losses. So essentially, you're either going to get maximum gain or you're going to have a loss, right? So that's why if our maximum gain is going to be $65, that's what we're shooting for per spread. And then you can see here, there we go. And we can see we want to try to keep our loss to $65 if we can. And so, 75 is where support is. If we start to get below 75, then we kind of watch to see, and buy back this spread at $1.30. That will keep our losses to $65, and much easier to come back from that loss, especially because we're doing a bunch of different trades than it would be if we were to let it go all the way to maximum loss and take a $185 loss. Again, not a whole lot of room between max gain and max loss. So a lot of times these vertical spreads, we think they're high probability, but they're pretty decent probability of getting a max loss too. About 1 in 4 chance of getting a maximum loss, essentially. While we have a 2 out of 3 chance that we'll get maximum gain. So it's one or the other. Generally speaking, it's one or the other, with a small probability of getting either a small loss or a small gain, or a small loss. So that wraps us up for tonight. I'd love to hear your thoughts on today's market posture and today's trade ideas. So there's a link popping out in the top right corner. Click on that link to take you to our Market Outlook forums. Post a new topic there and let us know what you think, and reply to others' topics as well in that forum. Kind of browse around and see what other people are saying and reply to their topics. You have to scroll down to the bottom. Once you click on a topic, scroll down to the bottom, and that's where you can reply. Love to hear your thoughts and share with what you're thinking with our Market Scholars community. Again, thank you very much for watching tonight. Subscribe to our YouTube channel if you haven't already. Like tonight's video by clicking the thumbs up icon. Comment on it. Follow on Twitter for more content, and join our Market Outlook community on Facebook. Have a great evening, everybody, and we'll see you all next time.